Hello everyone, this is Osama Rizvi from Primary Vision Network and welcome to Monday Macro View. There were a lot of discussion and debate about whether we're going to end up in a recession or not, or that the possibility, certain economists have highlighted the possibility, the promising possibility of a soft landing rather than a hard landing, and oil markets have been buoyant recently. Bearishness seems to be turning into bullishness. So I thought, as discussed in the previous episode and also as written in one of the insights at primaryvision.co by myself and Mark as well, I would encourage you to please check them out. We do this on weekly basis. I still remain skeptical about the idea of a recovery. Not that I'm a pessimist, I'm only a realist, and it is also, as an analyst, it's my job to highlight the facts and figures rather than just look at the rosy side of the rosy side of the outlooks. So let's jump in, starting from the first slide, which shows. So first of all, a little bit of context. There are markets, there are prices, that's the financial part of the economy. Then there are businesses, there are inventories, there is consumer spending, which can be labeled as the real part of the economy. And when you look at the real economic indicators, you seem to have a consistent theme of a downturn or of a slowdown, of muted, lukewarm economic activity from the past 7 or 8 months. You look at the ratio of inventories to sale for US in case of US manufacturing, US being the largest economy in the world and a good indicator of what's happening in the world. So you see at US business inventories, and they have remained elevated. Why? Because of low consumer spending and corporate investment on goods and services. So manufacturers, wholesalers, and retailers, they held together about 1.40 months of inventories in May 2023, which was up from 1.33 months of sales of inventory as compared to May 2022. Retailers have the inventories, the stocks at retailers have risen from 1.23 in 2022 to 1.30 months. What does this show? As you can see this chart here, it's slightly inching up, and it continues to inch up, that the consumer side has also started to get affected. One of the reasons that many observers were putting out was that the consumer side is still strong, but now we see that the consumer side is also weakening. When we talk about the global economy, it's very important to talk about China. China recently released its economic figures, and I think it ties very neatly to the disappointing theme that has been the highlight of the year in terms of China's economic growth. The quarter 2 saw a growth of 6.3%, but there's a catch in it. When this 6.3% growth is compared to the facts and the figures when there was a lockdown measures still in place. So you're measuring this from a very, very low baseline. If you measure this growth when those COVID measures were taken off, it was only a 0.8% growth in the second quarter as compared to the first quarter. And when you measure it year-on-year basis, it only amounts to a little over 3% of growth, down from 9% growth in the first quarter. So what does this show? This shows that the demand in the second largest global economy is also not that much. And there was also a very interesting point highlighted by Michael Pettis, if I'm pronouncing the name right, on Twitter, and I've resourced him as well here. So if China, even if let's assume China's GDP grew by 5%, but what are the drivers of this growth? Is it infrastructure? It is other non-productive government spending? Then that would not result or that would not contribute into the whole or the global economy. That would only be Chinese, and that would more of be centered across just highlighting the figures. So that's very important to know. What are the drivers of the global economy? And I highly encourage you to watch our recent Econ show and in the segment 5, where Mark talks about the drivers of this economic growth in China. And needless to mention, they are not really promising. China's crude oil imports is another reason, another indicator through which we can gauge the health of the Chinese economy. So China imported about 11.4 million barrels per day of oil, up 12% almost year-on-year basis and 15% almost pre-COVID levels. However, China's domestic demand is weak. Exports are falling in double digits. So where does this leave us? And this has been highlighted a lot by Clyde Russell from Reuters in his extremely insightful commentary. So this shows that most of the oil is going into the inventories, and the domestic demand isn't there. And what does this mean further is that this cements the other facts and figures coming out, like youth unemployment being at 20% or double digits. Taiwan, Japan, where core inflation is still an issue, higher than the Bank of Japan's estimate. South Korea, all of these are suffering from lower exports. So overall, the real side, the export side, the manufacturing side, they're still facing a slowdown. And I don't think that this amounts to, I don't think how can one read this that there won't be a recession or a slowdown. There is a possibility that, okay, that might not end up in the technical recession if the global economy doesn't contract for 2 consecutive quarters. But if you look at the labor markets, if you look at the wages, if you look at especially the developing countries and the cost of living crisis that has ensued as a result of a lot of bigger picture events happening in the previous 2 or 3 years, it's incredible. It's awful, actually. There are debt issues, food crisis. We have spoken about food crisis in the recent Econ show as well. So there is a lot that the mainstream media or the mainstream, the articles we read, that does not catch. And speaking of this, look at Conference Board's leading economic index, LEI, which is one of the best indicators out there for a recession. And in June, it dropped to 106.1, down from 106.9 in May. This is the lowest reading since July 2022 and 15th consecutive decline. If you look at the next slide here, it charts the fall in LEI and the probability of recession. So historically, LEI has dropped below 6-month moving average anywhere between 2 to 15 months before a recession. Now, currently, it has dropped below the 6-month moving average for 12 months. So there are 3 more months before we hit that deadline. But as we will see in the next slide, I think it neatly converges with other estimates as the yield curve, one of the gloomiest and most potent indicators is the yield curve inversion. And the Fed's New York branch calculates the probability of recession based on this. And in May, it put this probability at 70%. The Conference Board puts this probability at 99%, a recession in February 2024. And Bloomberg, different economists surveyed by Bloomberg, they put the probability of recession by 65%. Finally, the market sentiment tracker, the left side continues to outweigh the right side. The recessionary side is still heavy and recession is taking hold. We will discuss this next time, inshallah. Until then, take care, and I hope you enjoyed the show. Thank you so much.